Everyone's watching the NFL print money and the NBA triple its media deal. And meanwhile, the sport, with 162 games a season, no shot clock, and a reputation for putting people to sleep, just quietly crossed $12.1 billion in revenue. Wall Street's still calling it boring. That's the mistake. There are 3 financial reasons MLB is actually the most defensible sports investment heading into 2026. And one of them has nothing to do with baseball at all. Stick around. Start with the raw numbers, because they're genuinely hard to argue with. The NFL plays 272 games a season across 32 teams. The NBA plays 1,230. MLB plays 2,430. That's not a longer schedule. That's a fundamentally different business model, and most people analyzing these leagues never actually reckon with what that gap means at the revenue level. Here's a number that puts it in focus. During the 2020 return-to-play negotiations, MLB's own financial disclosures to the Players Union showed that each game generated roughly $980,000 in local television revenue across the league. Multiply that across 162 games per team, and you're looking at approximately $2.38 billion in local media revenue annually, just from the volume of games on air. Not national rights, not sponsorship, just the local broadcast inventory that comes from playing almost every single day for 6 months. Now compare that to the NFL's structure. The NFL pulls in around $12 billion a year in national media rights, which sounds like a blowout until you realize those rights cover 272 games total. Scarcity is what drives the NFL's per game value so high, and that's a real advantage. But scarcity also caps volume. You can't sell what you don't have, and the NFL doesn't have a Tuesday night game in July. MLB does, and so does Wednesday, and Thursday and Friday, and Saturday and Sunday for the entire summer. The NFL monetizes the event. MLB monetizes the calendar. That daily cadence is what makes the inventory genuinely different as an asset. Every day of the regular season, there are betting markets open, fantasy lineups being set, highlights getting clipped, second screen apps running, and local broadcasters filling airtime. That's not incidental. Sports betting alone has completely changed the economics of a mid-July Brewers game that nobody outside Milwaukee would have watched 5 years ago. Now, there's a reason to watch the third inning of any game on any given night because there's a live line moving on it. The pitch clock and pace of play reforms fit into this same logic, and most coverage frames them wrong. You'll see it described as MLB trying to appeal to younger fans or shorten games for casual viewers. And sure, that's part of it. But from a pure revenue standpoint, faster games mean more games fit into standard broadcast windows, which means more predictable ad inventory, which means advertisers can actually plan around MLB broadcast the way they plan around NFL windows. You're increasing revenue per game hour, not just making it easier for people to watch. That's a product improvement with a direct financial return. The criticism you'll hear is that volume dilutes value, that late September games between non-contenders don't move ratings and don't fill seats. That's true for some games, but it misses the structure of how the inventory actually gets monetized. Local TV contracts don't get repriced game by game. Sponsorship packages don't fall apart because a Tuesday game in August drew a 1.2 rating. The revenue base is anchored by the contract structure around the full slate, and the full slate is 2,430 games. That's the asset. Raw inventory only holds its value if the underlying asset keeps appreciating. And this is where the MLB investment case gets genuinely interesting, because most of the appreciation isn't showing up in the box score or the broadcast ratings. It's showing up in the property records around the ballpark. MLB teams have quietly become some of the most important real estate anchors in American cities, and the market still prices most franchises like they're primarily in the business of selling tickets. They're not. The teams with real long-term value are the ones that have negotiated development rights around their stadiums as part of public financing agreements. And those rights, not the team's win-loss record, are where the serious money is compounding. The global sports and entertainment buildings market sits at $315 billion in 2026, and is projected to reach $394 billion by 2030. That's a 5.7% compound annual growth rate, and MLB stadium districts are a core part of what's driving it. The model has shifted from single-use ballparks surrounded by surface parking to mixed-use districts, where the stadium is the anchor for residential buildings, hotels, restaurants, and retail that generate year-round revenue, regardless of whether the team makes the playoffs. Nationals Park in Washington is the case study people keep coming back to, and for good reason. The ballpark opened in the Navy Yard neighborhood in 2008, an area that was largely industrial and underutilized. Over the following decade, housing values in the Capitol Riverfront District roughly doubled or tripled in some accounts, with the ballpark functioning as the catalyst that made the surrounding development viable. The team was part of the story, the real estate was the story. Research across major U.S. sports venues puts the average residential value premium within 1 mile of urban MLB parks at about 4.7% above comparable properties, with rental premiums running steeper in dense markets. But the premium on what owners actually capture is bigger than that, because the appreciation that matters most isn't in housing values on properties they don't own. It's in the zoning changes, air rights, and upzoning that get negotiated as part of stadium financing deals, giving ownership groups control over land that becomes dramatically more valuable once the ballpark anchors the neighborhood. The Yankees are valued at $8.5 billion in 2026. Stadium economics and the real estate platform attached to that franchise are core inputs to that number, not just what Fox and ESPN are paying for broadcast rights. A content machine sitting on top of a real estate platform is a different animal than a sports team, and that's what the smarter MLB ownership groups have been building. So you've got a content machine sitting on top of a real estate platform. Now add the third layer, and this is the one that actually keeps NFL and NBA owners up at night, even if they never say it out loud. The NFL's $110 billion media deal over 11 years starting in 2023 looks like total dominance until you think about what it actually means structurally. They're locked. Whatever happens to live sports rights between now and 2033, the NFL collects the same contracted rate. If the market moves, they watch from the sidelines. That's not a criticism of the deal they signed. It was a good deal at the time, but it means their media upside is essentially frozen for the better part of a decade. The NBA just went through its own step change, tripling national rights from roughly $2.7 billion to about $7 billion annually, starting with the 2025-26 season. That's a real number and a real win for the league. But here's the complication. Local RSN exposure still accounts for roughly 30 to 40% of media revenue in many NBA markets, and that part of the business is bleeding out. The national deal is massive. The local side is a problem they haven't fully solved. MLB's national rights sit at $1.7 billion a year, which looks small on a comparison chart and gets dismissed accordingly. That's the wrong way to read it. That number is sitting in front of a renegotiation cycle in a market where live sports rights have only moved in one direction. The NFL and NBA deals are already done. MLB's next national contract is the one remaining agreement in major American pro sports that still has genuine upside surprise built in. And nobody's pricing that in because they're too focused on the $1.7 billion number rather than where it's going. The RSN crisis is also less of a death sentence for MLB than the coverage suggests because the response has actually expanded reach rather than contracting it. Teams moving games to free over-the-air television and direct-to-consumer streaming don't lose an audience, they add one. The cable subscriber who already had the RSN still gets the game. The person who cut the cord 2 years ago now has access to games they couldn't see before. That's addressable audience growth, dressed up as a distribution problem. Then there's the sponsorship number, which doesn't get nearly enough attention. MLB led all U.S. sports with $7.66 billion in sponsorship revenue in 2024. That's commercial diversification, operating independently of whatever's happening with broadcast rights. When private equity started moving deeper into MLB ownership than any other American league, it wasn't because the sport is exciting. Institutional money runs toward underpriced assets with multiple revenue layers. That's exactly what the numbers describe. The boring label was always the point. Boring assets don't attract speculative capital. They attract patient capital, and patient capital compounds. 3 layers: content inventory that runs every day for 6 months, real estate platforms that appreciate whether or not the team wins, and a media rights position that's the only one in pro sports with genuine upside still on the table. If you're building toward a front office or sports investment career, don't track the teams with the biggest national deals. Watch the ones quietly stacking development rights around their ballparks. That's where the money's actually going. Subscribe if this changed how you think about sports as an asset class, and watch the next video where we break down exactly how MLB owners are structuring those real estate deals.